review the indexed universal life market in general. Then I'll review just high level which products we have available on our universal life portfolio. Then I will talk about some specifics of our Income Advantage plan and also the accelerated benefit rider that's attached to the policy and our guaranteed refund option rider. So the IUL market, it's grown significantly over the past 5 years or so. In 2011, IUL was 10 to 15% of the total market, and just over half the top IUL companies offered an IUL product. Today, the IUL makes up over 50% of the UL market, and most top companies offer at least one, if not more, IUL products. So, one of the reasons why Mutual of Omaha entered the IUL market is because we do see the potential in this product and that the market is shifting towards the IUL. But it also just rounds out our portfolio of universal life products and gives the ability to accumulate that cash value, which we don't have today. So that's one of the reasons why we decided to introduce this Income Advantage product to the distribution. Currently, we have 4 guaranteed UL products, which includes a simplified issue product, which is quite rare in the UL space. And we also offer a second to die product along with our Guaranteed Universal Life and Guaranteed Universal Life Plus products. So these are the guaranteed ULs that we would use primarily for just death benefit protection, permanent protection. Now with the release of the Income Advantage plan, we now have 3 current assumption universal life products. Now when I say current assumption, there's 3 types of current assumption universal life products. There's fixed, there's indexed, and there's variable. So our fixed ULs include our AccumUL Answers and AccumUL Plus, and they have a current interest rate of 3.75 and 3.05% respectively. These products have a guaranteed minimum of 2% and 3% respectively. Now these products, they're good products, but they do offer the lowest variability of returns, especially due to today's low interest rate environment. The cash value is just not building in the policy like it did in years past when the interest rates were higher, of course. Now, Income Advantage, our indexed universal life, does offer that variable, medium to high potential for returns. It's linked to the Standard & Poor's 500. And now we chose the Standard & Poor's as the index to base our IUL off of because it is the most common one out there. Pretty much everybody knows what the Standard & Poor's 500 is. And I think what you'll see throughout our product design is that we tried to make it as simple as possible. Now that third type of current assumption product, the variable universal life, we don't offer a variable universal life at this time. Not to say that we won't sometime in the future, but there's no plans at this time to release a variable product. So there's 2 types of common sales when you look at the indexed universal life market. There's a death benefit sale. All that is illustrates the lowest premium to allow the policy to carry to a designated age based on the current assumptions. Okay. The second type of a sale is a distribution sale. So we illustrate the highest distribution amounts either through a loan or a withdrawal or a combination of both for a given period of time that's paid into the policy. So you're overfunding this knowing that you want to withdraw money in the future to use for retirement income or college funding or to repay a mortgage, any type of cash accumulation need that you would have. This is the product to do it, is the IUL. Now our product, we're going to focus on distribution sales. We have our GUL and our GUL Plus for death benefit sales. So That's what we're looking at on our IUL, is that distribution sale. Now, when you illustrate our product, just to give you an example of how the distribution would work, if you had a 35-year-old and they pay $10,000 a year in premium for 30 years, at age 65, the account has accumulated almost $500,000 in value. At age 66, around retirement time, they stop paying their premiums and they withdraw funds from the account annually for 20 years. So that's going to give them an income stream till their age 86. In this example, they would withdraw an amount just under $30,000 per year. And then the remaining policy carries to age 100, so they still have that death benefit protection to age 100. And all of these calculations can be performed within the illustration software. We use WinFlex for that software. And as you can imagine, they're a little bit tricky to run, but we can certainly help you with running any quote that you would need. All you would need to do would be to provide the parameters of your client, and we would be happy to run those quotes for you. Now, our Income Advantage, we have 3 crediting strategies that are available. The first one is 100% participation rate with a mid-range cap. So the cap on our product is 11.5%. So 100% participation with 11.5% cap. The second option is a higher participation rate with a lower cap, so 140% participation with an 8.5 cap, and then a lower participation rate with no cap. So it's uncapped, so with a 65% participation rate. We also offer a fixed account with a guaranteed 2% interest rate. The current interest rate for that fixed account is 3.25%. Now, we chose these crediting strategies because they're the most common, and we want to offer more than just one, so the clients had more options to choose from based on their individual situation. Now, when they're choosing a crediting strategy, they can put all of the funds into one strategy, or they can split it up against 2 or all 3, in fact, or even some going into that guaranteed interest rate. Now, with our product, we have a floor of 0%. So what happens if there is no change in the percentage of the Standard & Poor's 500, or if there's a loss, the floor is 0. So they're never going to lose their money. They're just not going to be getting an interest on that particular money at that time. So they can't really lose with this type of a product with that floor of 0%. Now, we calculate interest based on the value of the Standard & Poor's 500 at the time the bucket or the premium payment was created, and then we compare it to the value 1 year later when the bucket matures. So premiums are paid 1 month, it goes into the bucket, it starts the clock a year from then. We look at the change in the index, and that is the percentage of interest that's calculated on that individual bucket. So if you look at it like this, each month you make a monthly premium payment that creates a bucket. Okay? The next month that you make a premium payment, that creates a second bucket, which is looked at a year later to determine the interest rate on that particular bucket. So it's kind of ongoing. Every month we're looking a year later to see what the change is, and that's what's credited to the account. So that's what's meant by annual point to point. Now, if the clients want to access their cash value later on in retirement or when they need the funds, they can do it a couple different ways. They can withdraw funds from their policy. They can withdraw all the funds, which is a full withdrawal, receive the cash value less any surrender charges, if applicable, and then the policy terminates. Or they can do a partial withdrawal, receive part of the cash value, and the policy continues on, but with a reduced death benefit. Now, the other option is to do loans. So they're essentially just borrowing against the cash value, and we will charge a previously specified rate on the loan balance. We will credit a certain amount onto the underlying collateral. So with Index Universal Life products, they can choose the different loan types. So let me explain these just a little bit. There's a standard loan. The standard loan just means that interest is charged and credited are known in advance and often with a wash loan provision. So what I mean by that is our policy in year 1 through 9, they're charged 4% in the rears, but they get a 2% credit. In policy years 10 plus, they're charged 2% in the rears, but they get a credit of 2%. So there's where the wash loan comes into it. We're charging them 2%, but we're crediting them back 2%, okay? On another type of loan that they can do is an index loan. So all that is the interest charge is declared in advance. Interest is credited based on the underlying index performance, okay? So if the index performance is at that time is 2% or 4%, that's what it's going to remain for the entire time of that loan. Okay. All right. Now with these policies, automatically included is a lapse guard. The reason we do this is to protect the client. Okay. This is a no-cost rider that's automatically attached to these policies with issue ages less than age 76. The Lapse Guard is designed to prevent the policy from lapsing, specifically policies that have been overfunded, that have had a level disbursement taken out for an extended period of time in retirement. Exercising of this policy keeps the policy from lapsing. So no policy loans will become taxable as income under the current tax laws. And when the Lapse Guard rider is exercised, the accumulation value is reduced by 3%, and the death benefit will always be greater than the loan. So that's a built-in protection for the client to avoid tax consequences from withdrawing money out of the policy. Because what happens is if they let the policy lapse after they've refunded or taken out withdrawals, etc., they could have to pay taxes on that money, on the gain of that money. So we don't want that to happen. So that's why this particular rider is built into the policy. Now, our coverage, it has our ABR for chronic illness and terminal illness. So the accelerated rider for chronic illness, what that means is that if the person is unable to perform at last 2 of the activities of daily living, such as eating, toileting, transferring, that type of thing, they can withdraw funds out of their money. Another trigger is a severe cognitive impairment. Okay? And I'll explain these in a little more detail here coming up. Now, there's no upfront cost for this ABR rider, and there's no additional underwriting for it. So think of it like this. If I have this coverage and I become chronically ill, so in the last 12 months, a physician has certified that for a continuous period of at least 90 days, the insured is unable to perform at least 2 of the activities of daily living, or they require substantial supervision to protect themselves. Due to this severe impairment, they can accelerate a portion of their death benefit and receive a lump sum check. So let me explain this, how this actually works here. Okay, so the accelerated rider for chronic illness, it allows a maximum benefit of up to $1 million or 80% of the death benefit. Okay, they can do multiple accelerations. They're allowed to accelerate once every 12 months as long as the amount they request does not exceed the IRS per diem limit each year. So for 2016, that amount is $124,100. Okay? So again, this is built into the policy regardless of age or the risk class, and they just have to provide that doctor's, physician's evidence that they're chronically ill. It's available on not just our Income Advantage IUL policy, it's available on all of our universal life policies, including that Express product. The only product that this rider is not currently on is our GUL Survivor policy, but that is going to be added in the May timeframe. Okay, so let's look at some of the advantages of a chronic illness versus just a traditional long-term care rider. So there's no upfront cost to this rider. You pay on the back end, and an example is coming up here. Typically with long-term care riders, there is a cost to that. There's no additional underwriting. So, if they qualify for the life insurance, they will get this rider added. It's not restricted based on risk class. Oftentimes with a long-term care rider, it's not available, so substandard ratings. Typically table 5 or higher, they will not allow a long-term care rider to be added to the policy. And the benefit amount is flexible. So the client decides how much they want to accelerate up to that IRS per diem, and there's no strings attached. Okay, but typically a long-term care rider, it's limited maybe to a percentage of the face amount, maybe 1%, 2%, 4%, something like that. And we'll allow multiple accelerations. As long as they're 12 months apart, they can accelerate numerous times up to that maximum amount of 80% of the policy amount or $1 million. Long-term care riders, typically they're paid for a set number of months, and it's defined at the time of issue. With the chronic rider, there's no restrictions on the use of the benefits. So it's a lump sum check. They can do whatever they want with the money, and we don't care. Where most long-term care riders only allow the benefit to be used for qualified long-term care expenses. Okay, so here's how it works. So say you have a client who has a $500,000 policy. The maximum allowed, 80%, so that's the maximum that they can accelerate, is $400,000 total out of this policy. So let's say they request an acceleration. So what happens then, since there's no cost on the front end, there's a cost on the back end. So think about it like this. You're not paying for the rider unless you use it, and then there is a charge. So how that charge works, we call it an actuarial discount. So what happens is at claim time, our medical directors get the client's medical records. We determine the client's life expectancy. We multiply that by the current Moody's corporate bond yield, which in this example is 4.5%. Our medical directors determine this client has a 3-year life expectancy, multiply those together, so the actuarial discount is 13.5%. So we're going to keep $13,500 out of this requested $100,000. There's also a flat $100 charge. Okay, so what happens then? The client's going to get a lump sum check of $86,400, so they can do whatever they want with it. In this example, Bob's wife, just took a leave of absence for work to care for him to cover her loss of income, $64,000 a year. They use that to help pay their normal bills because she's not working. It's to supplement her income for not working. And then they have $22,000 left over. So they can do whatever they want with that additional or any of the money. So in this instance, they take a vacation for the entire family. So when you're looking at this, keep in mind that if the client's life expectancy is 10 years, 15 years, it's probably not worth accelerating because the charge for acceleration is going to be significant, and the lump sum check that they're going to get is reduced greatly. So keep that in mind. When you're explaining this rider to a client, that it really is intended for somebody who truly is chronically ill. Um, so yeah, just keep that in mind. But one thing with this, and I like to look at it this way, I like this coverage, this chronic illness rider, for a couple different reasons. But, you know, I have traditional long-term care. My husband and I do. We have 3 years each shared care. So what would happen, though, if my husband used 2 years of my coverage because he used up all 3 years of his? That would leave me with 1 year of coverage. That's probably not going to be enough if I need long-term care coverage. So I could, if I had this policy with this chronic illness rider, I'm not paying for it unless I need it. And if I did need it, I could use my 1 year of long-term care and then start accelerating out of this life insurance policy to help make up the shortcoming, because my husband used 2 of my years. So I like to think of it as a backup plan to long-term care, or for somebody who might not qualify for long-term care based on their condition, but they would qualify for life insurance. Because again, we only underwrite for life insurance. Okay, let me show you what happens in year 2 then. Okay, in year 2, the remaining face amount then is $400,000. So they still have $300,000 that they can request at a later time, as long as it's 12 months from the initial request. So in year 2 then, okay, I got my death benefit, $400,000, $300,000 I can still accelerate. Let's just say in year 2, I again want to accelerate. I'm going to request another $100,000, or I can request $50,000. It doesn't matter to us. $100,000 is what I'm going to request. Let's just say the life expectancy, it's reviewed each time they request an acceleration. So 2 years later, the life expectancy is 2 years. So the actuarial discount is going to be $9,000 plus that $100 fee. So they're going to receive a lump sum check for $90,900. So again, Bob's wife takes the leave of absence. She looks like she gave herself a raise of $70,000 versus the $64,000. And they still have over $20,000 that they want to gift to the children. So keep this in mind. I mean, it's a great benefit. It's there if they need it. They're not paying for it unless they use it. Okay, so keep that in mind. Now the policy continues. $300,000 is left in the policy, and they still have $200,000 they can accelerate at a later time if they want to. All right. Now, our Indexed Universal Life has our guaranteed refund option included with the policy for certain policy holders. What this is, it's a no-cost rider that's added at the time of issue. It allows a policyholder to fully surrender the policy for return of premiums. So what happens in year 15, they can request a refund and get back 50% of their premiums. In years 20 through 25, if they want to surrender the policy, they will get back 100% of their premiums. There's a 60-day window at each of those times in which they can accelerate that, and the maximum that they can accelerate is 35% of the face amount, okay? Now, upon exercising this rider, the policy terminates. Okay. Now, if the client is substandard or a tobacco case and they're under age 50, it's not added to the policy, and it's also not available for substandard table 5 through 16 if they're 50 and older. And they have to have a minimum dial to age 100 in order to get this guaranteed refund option added to their policy. If by chance they do lose that guarantee to age 100, we do have some catch-up provisions that they can pay a little bit more premium to get that dial to age 100. And then we don't care if they pay short pay. So if they only pay their policy a single pay or, for 10 years, 20 years, it doesn't matter. This is still going to be on their policy. Okay. So with that, I will go ahead and open it up for any questions that the group might have.
Thanks, Sandy. I'm going through and unmuting everybody right now as we speak. Hopefully there's not too much feedback. Okay, I have everybody unmuted. Does anybody have any questions at all as far as for Sandy on the new IUL? No questions. Okay.
Will you be issuing a commission schedule on this?
Yes, we can get you a commit. We're not going to show it here, but we can get you a commission schedule. Who am I talking to?
My name is David Block.
Oh, David. Hi. Yeah, I will follow up with you on that, David.
Thank you.
Any other questions?
Okay.
Okay, if there are no additional questions, thank you everybody again for joining us this morning. Sandy, thank you again. It's always a pleasure to have you with us. We'll do this again sometime as well, but everybody have a great day, and thanks again.
Thank you.
Thank you.